I really think we are in this very close to stagflation-like environment. And I don't think, as much as I hoped last time I saw inflation coming down, I thought maybe the Fed will finally pivot in July before September on an emergency basis. But given the report that just came out and Trump's new threat of 30% tariffs again, if deals aren't made by August 1st, I think we might see another quarter or so of higher inflation.
Alrighty, folks, we've got our inflation reading this morning, CPI, both headline and core. We've got talk of a Fed replacement for Jerome Powell. We've got tariff letters and tariff deals, and we've got a big, beautiful bill, and we've got all this kind of stuff. We're heading into the second half of 2025. I just want to do a check-in with Anna Kelly, see what she is thinking, where we're at. Are we about to fall off a cliff? Are we about to hit the turbo boosters, or somewhere in between? Anna, I don't know where you want to start. I suppose we start with inflation. How are you?
Sure. I'm great. It's good to be here with you as always. I think this is kind of more of the same. You and I have been talking for probably 2 years or so now. I think we have receipts. We can go back and look at the video, but kind of warning of a stagflationary type environment where we have
you were the first. I want to stop you right there. You were the first to bring up stagflation well over 2 years ago as a real risk. So just give you your flowers. You deserve credit for that. You saw it before anybody else. So kudos.
Sometimes I get it right. The problem is timing, right? It's like I've underestimated how long these things can last, and so I think that's where we are today. We think we see a number, a headline number, and then you want to get excited and say, okay, things are turning. And it's either turning better or worse for employment, or better or worse for inflation. And then everybody's like, okay, the Fed is won. Nope, the Fed is lost. Nope, we're going into recession. Nope, we're going into hyperinflation. And the reality is, as we've been looking at these numbers, is one number does not a trend make and a cycle make. And there's so many different complexities that the reality is all the projections have been wrong. But when you go back and you look in the past, similar to the 70s, which this looks a lot like the 70s and a lot like the 20s as well, with different reasons. But you have both inflationary pressures, which we could likely blame mostly on COVID and the supply chain disruptions, and then all the post-COVID stimulus that got everybody spending with abandon. And that drives up prices when there's lots of demand because people have more money to spend. And so, we knew, hey, inflation is here. It may take a while to get down. But because of how much money was in the system, we really didn't start to see the major recessionary pressures and the real drag on economic growth because of how much money was in the system from all the money printing post-COVID. And so, we've seen a lot of recessionary type conditions like I've talked about. We've talked about rolling recessions. I think you mentioned that before I did. I'm like, it looks like recession. And then you're like, well, it might be rolling. And it's like, yeah, it might be. But you've got kind of this stagflationary type environment where you have recessionary conditions in certain sectors and you have inflation up and down rolling through different sectors as well. So you almost have this rolling recession, rolling inflation, but all in all, if you look at it, it's kind of like it's staying right in this area at trend where inflation's between 2 and 3%. Growth is less than the 3%. And so this inflation's dragging down the economy. So last time that there was an inflation print, it was actually a little bit better. And people thought, okay, it's time for the Fed to pivot. The inflation risk is over and the tariff risks are overblown. And the reality is now this most recent print showed us that inflation was higher than expectations. Core was a little lower than expectations, but still we're somewhere in the 2.7 to 2.9% annualized inflation. And so if this is a trend and it continues into the next quarter and the next quarter, then we really have this risk of stagflation. And it might turn from stagflation-like to true stagflation. We have to see where tariffs go. But we have surely slowing economic growth, even though we had an okay employment and new jobs creation report. We see some continuing claims going longer. We see people dropping off the employment rolls and an increase in bankruptcies. And so I really think we are in this very close to stagflation-like environment. And I don't think, as much as I hoped last time I saw inflation coming down, I thought maybe the Fed will finally pivot in July before September on an emergency basis. But given the report that just came out and Trump's new threat of 30% tariffs again, if deals aren't made by August 1st, I think we might see another quarter or so of higher inflation. I think ultimately that is going to put a drag on the economy and put us into that true recession that's not just at the bottom 70%, but throughout the economy. And I think ultimately people can't handle the inflation any longer. They're going to cry uncle, and it's going to put us into that cycle where recession is what gets us out of stagflation. So if I was a betting woman, that's what I would bet is happening where we are. And I don't think we're going to get a rate cut for a few more months.
Yeah, no, I think a July rate cut just went out the window. You can't be cutting rates with the headline going up 0.3 and core going up, I think 2 months in a row or something. You just, it's a bad look.
Especially when employment went down from 4.2 to 4.1
to 4.1.
4.1. You can argue what the numbers are, but it's the reality is these are the numbers that they're looking at. So where we were saying the balance of risk was low inflation, high unemployment, now it's kind of like higher inflation risk than there is employment risk.
Yeah, you can't cut in July. There's no chance. I don't know if you heard this. I just talked about it this morning, but Jamie Dimon, I think it was in Italy, somewhere in Europe, gave a speech, and he actually says the market is underappreciating the chance that the next rate move is up, not down.
Yeah.
Right. Jamie Dimon said the market believes it's about a 20% chance that the next move is up, not down. He said he believes it's 40 to 50% that the next move is up, not down. How does that feel?
He's been warning of inflation being a bigger risk than what people think for quite some time. So I've agreed with him there. He's a smart guy and he looks at the data as much or more than I do, right?
He has a lot more data than you and I have.
Exactly. So I'm not going to, put myself up there with Jamie Dimon, and I reluctantly disagree with him. But I do think that there's enough pressure on the majority of the people who are spending that any increase in inflation initially is going to be absorbed by the wealthier, but not absorbed by those that are already struggling, the bottom 70 to 80% now. And I think that there is more risk maybe to the downside of recession being deeper more quickly than maybe what Jamie sees, because I just don't think people are going to absorb the tariffs. And so I don't think that the risk is 50% that rates go up. I think there's enough pressure on the downside to growth and contraction that won't happen. But I do think that rates can stay flat for quite a bit longer. And initially, if you look back at history with tariffs, the initial tariffs kind of are absorbed as those who can absorb it will. And it takes several months. I don't remember the statistics, but I think like 9 to 12 months, almost like, a rate cut takes 18 months to get into the system. If these tariffs go into effect in August, you're going to see, I think, an increase in inflation. But how long does that last, and how long are the prices absorbed before it just puts us quickly into a recession? I don't know the answer to that. I don't think anybody can honestly say that they do. But typically there's a bump in inflation. And then when the consumers cry uncle and they don't absorb the costs, and the companies have to take less profits, and then they can't, and then they start laying off people because they can't absorb, these additional costs when people aren't buying, that's when you really start to see actually deflation. And so I think, like Jamie says, we have inflation risk, but I think that's followed with the consumers rejecting, not paying the higher prices, the layoffs coming, and then companies have no choice but to cut prices. So ultimately, a lot of economists will tell you and give you lots of data that tariffs become deflationary in the longer term.
Yep.
So it's really hard to time these things, Michael. And that's where I say, like, I can see the big picture and where things could go, but trying to call it, is it going to happen in September, December? I fear that this whole year we might have higher rates, and I don't like that. I have multiple loans resetting my 5-year rate that I locked in for that 5 years thinking surely we'll be past that within 5 years. Well, guess what? I've got loans resetting this year. And so I'd like to have that recession. I'd like for inflation to come down. I'd like those rates to be cut. But I don't think we might not see it, Michael, till next year if the consumer absorbs those tariffs and if they really go into effect in August the way that the economy thinks that they might.
Yeah, I think it's going to be very interesting when, because again, we both studied finance and economics, and I'm thinking about being an economics student 10 years from now when they write about this period. And it's going to be interesting. Will they write about it as stagflation or stagflation-like, or will they write it down as the first true rolling recession? I'm still in that camp. I've been there for a couple of years. And I think we're going to start to see things come out of it. One of my counterpoints, opposite of what most people think, is I actually think housing is going to start coming out of this in September. And when people hear that, they think I'm crazy. But let me explain.
Did you hit your head?
Let me explain. Because again, I think there's a bunch of logic there that most people are missing because of the headline is so counterproductive or different than they think. So let me be very clear. I called for a housing recession and depression, crash in transactions 3 years ago, right? We're down arguably 40%, rough and tough, and was right. And now what I'm telling people is I think July and August, so this month and next, will simply be the bottom. And that means that September 2025, existing home sales transactions will be higher than 24, and looking at the numbers, also higher than 23. That does not mean this is some rip-roaring housing market, but it does mean it is net positive to GDP. Housing has been a drag on GDP for 3 years. However, if existing home sales, I think from memory, last year we did 382,000 existing home sales. If we do 392, that's an extra 10,000. And that 10,000 gives fees and transactions and, all of that. So I am saying that September 2025, there will be more existing home sales than 24 and 23. I am saying nothing about price. I'm saying transactions.
Yeah.
And again, that's important because housing in a normal economy is 12.5% of GDP. We have been in a depression. We are something probably at 8 or 9% right now.
Mm-hmm.
If we start in September adding year-on-year numbers that are positive, and then November is positive and December is positive, housing was most affected by higher rates.
Yeah.
Now, 3.5 years later, we have to find the bottom eventually.
Mm-hmm.
That's just how this system works.
Yeah.
So I'm calling August is the bottom, and September will be the first year-on-year growth. And I'm calling it 24 and 23B because both of them are right around the same number, 382 and 387. So that's what I'm calling. I'm trying to be very, very clear with people.
Yes. I'll bet you $20, Michael, that you're wrong.
Nice. I got a bet. I like it. Write it down.
I'm actually going to put a bet, $20. We're putting it on live, so we're holding each other accountable.
Existing home sales, which will be reported in October. Exactly.
Timing. So I think your timing is wrong, but I like your thesis. I think it's possible. I don't think you're totally crazy, right? Yeah. Here's what makes me think it's going to be a little longer.
Okay.
I think that people are going to see this headline of CPI today and they're going to freak out. Why? Because you're already in pain. You're already saying, oh my gosh, like I can't afford a 3% increase in groceries and eggs and gas and, insurance and all of my regular expenses anymore. And one of the things about the CPI report, it just came out today and I haven't had a chance to really dig, but the initial things that I looked at is the things that went up in prices actually this time kind of matter to every household, Michael.
Yeah. I looked at it. I looked at it pretty detailed this morning. And if you came into this print saying tariffs are going to be impactful, you got exactly what you wanted. Furniture, toys, personal electronics, things that we import all went up. And some went up by big numbers. Mm-hmm. You're right. Also gas and energy. Although I actually think that's a head fake. Because again, when you look at the chart, when this CPI data was collected, the Iran conflict was going on. And we had that very quick week where everything spiked. And now we're back to where we were. So
Yeah,
again, energy was up, I think it was 0.9%, which is 7.2% annualized. I think that's a statistical
it
anomaly.
very well could be. But again, now we've got increased threats by, Trump against Putin and sending
Yep.
more weapons to Ukraine and threatening sanctions again. And so it's like all these things matter. To your point, we have to, when we look at the data, say, is there something external that's putting, temporary artificial pressure? And I think the answer is yes. And a lot of what we're seeing, there's a lot of global things that are happening that are impacting the US economy, both from a growth standpoint and from an inflationary standpoint. And so, I think, though, all those things matter, and it's hard to tell how they'll play out and how transitory. Our word of the couple of
Yeah.
years, right? Word of the 2020s is transitory, I think. How transitory are these pressures, and how lasting are they? But I think that the consumer, when I look at the statistics, and again, it's about 70, it's a little higher percent of US households are already so living check to check and now debt constrained. And we're starting to see defaults even in low rate, mortgages, more evictions, more layoffs in small businesses, things like that. So I just tend to think that we are going to have consumers who, when you're in these big economic cycles, Michael, and you and I talked about this as well, you go from a little bit of pain, you have this irrational exuberance at the top of a cycle. And then as the curve starts to come down and you start to decline economically, you have a little bit of worry, and then it turns to like anxiety, and then it turns to fear. But even that fear stage can last a year or two until there's so many things that are like, oh my gosh, now I'm really afraid, and now I cry uncle. And I think that the people that are living check to check, and even people who aren't, even the older, wealthier consumers, they're starting to pull back in some of those discretionary expenses. And they're starting to think, what if inflation does get bad? Because the headline news, if you turn on any news channel, what are they reporting? Tariffs, inflation, tariffs. So when they see a print, those who might have said, okay, the economy's softening, I'm going to go buy that house because rates are about to be cut. I think that those on the sidelines are now going, oh crap, I'm going to have to wait longer. And why would I buy a house today in August, September, if I think that these tariffs, let me give it another quarter. Let me see if they go down. Let me see if rates come down. And I think they hold steady. So it's not that I disagree with your thesis, but I think the timing, I think there's so much fear that's turning to a deeper level of fear in most people that I talk to, no matter what their economic condition is. We see it in our comments. I think that fear gauge is getting worse. And I think people hold off on existing sales. Now, one thing I do think we could see on new home sales, where is there really distress for that an average home buyer is looking for to be able to make the numbers work when they want to move? And honestly, it's the new home builders. They are now saying, hey, we're gonna have to cut prices even more because we can't get people to buy. And there's a huge backlog of inventory of new home sales across the country. And while it is mostly limited to certain geographies where everybody was moving to after COVID, and that supply is finally coming online, those home builders are now starting to have to really cut prices, and they're the ones doing the rate buy downs. So if anyone's incentivized to go buy a house, why would I buy a used home that's 20 years old that needs a little bit of work, even in a low supply area, if I can go build in a new home development, get the same house, but get a 5.99 or 4.99 interest rate and everything I want turnkey move-in ready? So I think the home builders have enough pressure right now. They're going to start even trying to buy down more or lowering their profit margins, which have been historically high. And that's going to incentivize those that are buying to go buy a new home instead of existing homes. So that would be my nuanced difference, I think, and off the cuff, my thoughts.
Yeah, no, I love it. And again, I always like to put out dates because by calling dates, you actually force yourself to learn.
True.
So I'm definitely calling September. I like that we have a $20 bet. Again, very clear. Existing home sales, September 2025, which will be reported in October, I'm saying will be better than 24 and 23. Anna's taking the other side, saying that will be delayed a little longer.
Yeah.
Let's see what happens. But back to inflation, because I went a little deep on this, because again, figured out the oil thing or energy. I think it's a head fake. Goods, absolutely. If you're Powell and you say that that's coming, you could see that. But what I think a lot of people are going to miss is services. Services were deflationary, not disinflation, deflationary, right?
Yes.
Lodging, airfare, things of that nature were deflationary. And if you don't know this, imported goods are about 12 to 15% of our economy. Services make up a much, much larger percentage. So if we're heading into an environment where services are deflating, even if we had inflation in toys and furniture and other stuff that we import, it ain't going to matter. It will be shielded by these much, much bigger numbers.
Yes. And the really important thing to note about that is that we are in the summer session, obviously, and it's when most families take vacations because it's when their children are out of school.
Yep.
Why do we only do big trips in hot places when it's hot as heck? Because it's when our kids are out of school, right? But who is actually spending money still on vacations? It's that higher income earner. And when the higher income earners are pulling back and saying, we better do a shorter trip again.
Yeah.
Let's go
instead of Europe, we'll go to Florida.
Exactly. And flights, airline, even though ticket prices have tried to tick up, you can get some great deals if you time it right.
They were down 4% in this reading.
Exactly. And that's at a time when they're usually at their highest, most profitable sales. So,
correct.
Back to my kind of thesis that as these economic cycles begin to become very contractionary right before they hit the trough, which we call the recession, the upper income has to start pulling back. And so services sector pullback is an indication that that's starting to happen. And that's another reason why I don't think that a lot of these tariffs are actually going to be absorbed, but I think it's going to take us 6 to 9 months to really see where do they get absorbed by whom, what sectors. And services right now, tariffs are mostly goods. But when people are worried about their cost of living going up and the cost of the goods that they want or need to buy going up, think of things like computers and phones when your kids go to high school and when they go to college, they're going to have to spend that money in August or September to get those more expensive things. But then do they continue in October, November? Maybe they do it in November and December because it's Christmas, right? And then you start to see the reality of how much is ongoing purchase of these things, not till January to, May of next year. So it'll be interesting to see. But I just think we need to not lose sight of the fact that, yes, while inflation seems to be ticking up again, and while tariffs might make that worse for a while, there is just as much risk to the downside as consumers pull back, that it's what finally is like that final nail in the coffin that puts us into a recession. And Powell has basically said that without saying that, and some of the other Fed governors that have come out and said, listen, we would have cut rates if it wasn't for Trump's tariff threats. It's so much risk that we have no choice. And so, whether you agree with them or not, it is what's handcuffing them as they wait and see because of the timing of this thing. But the risk is equally bad on both sides, is my estimation.
Yeah, I agree with that. I think tariffs are, short-term inflationary, i.e. look at the data today, toys, furniture, XYZ. However, I think longer term, they are truly demand destruction and switching costs and delayed purchases and all of those things. So I think they will ultimately prove to be disinflationary, if not outright deflation. Right. Let's actually switch to the one big beautiful bill. It's now law or passed or whatever the right vocabulary is. Huntington Bankshares CEO Steve Steinour, hopefully I said that close to right, actually talks about something in the real estate space that he actually thinks is going to be a boom to the economy. His quote was, "Accelerated depreciation is going to be a huge boost to onshoring manufacturing and other real estate expansions." Do you think this accelerated depreciation is going to initiate a building boom, perhaps?
That is the goal of the administration for sure.
Clearly.
Yeah,
Clearly.
I would argue that, while there is a threat of inflation, potentially, let's just say for sake of argument, those that say we are going to have higher inflation will never get back to 2%. We need to accept a 2.5% to 3% as normal. The administration, without saying so, believes the same thing. That's why their goal, part of their 3-3-3 plan, is to get growth at 3%. So even if you have higher costs of inflation for a while, and let's, be very, very clear, when you bring back and you reshore and you try to spend the money to create that growth, initially it's inflationary, and initially it costs a lot of money. It's going to cause the government to spend a lot of money to give those incentives, with the hope that they kind of flatten that curve of government spending and debt increasing, and that ultimately they bring back enough businesses, enough jobs, enough manufacturing that they get that GDP humming at that 3% or higher, so that they can absorb a little more inflation. Because if things are good, and in our world 3% GDP is good, then you can absorb higher costs that are less than that 3% and still have what's considered a healthy economy. No doubt about it, as a commercial real estate investor, it's a huge incentive, because right now bonus depreciation was down to about 40%. So if I'm only able to accelerate 40% of what I normally have to wait 27 and a half to 37 and a half years to depreciate, I can accelerate the stuff and take a one-time tax deduction against my purchase and my income. If I can accelerate 100% of the things that are shorter term life, then I get a huge tax deduction. And honestly, that's why there was so much still buying and overpaying for commercial real estate into 2022, because we had that really high accelerated depreciation, where I could go sell a property, make a few $100,000 on it, go buy another property, even without doing a 1031 exchange and finding the property, quickly enough. I could then go buy a property and take $1 million tax deduction that wipes out my capital gain on the old thing and incentivizes me to pay a little bit more because of how much I'm saving on the taxes. And so that's going to happen again. And I think that is going to be a boost to those commercial real estate investors who've kind of been on the sidelines, to say, okay, maybe I'm still slightly overpaying based on where cap rates are today, but if I think that rates will be cut in the future and I can refi lower or sell at a lower cap and I get a huge tax deduction, it's going to be that carrot that's going to get some of the players to come off the sidelines in commercial. And I think the same mindset will pass through to a lot of these companies that are incentivized to bring business here, to build, put more into R&D and more into manufacturing.
Yeah, I think there was a line item that says if you're building a manufacturing plant, you can take all of that year one. That's like, wow.
Even the stuff that would be longer term depreciation.
Yeah. I think there's a caveat if it's because, again, right, like you said, the administration wants to bring manufacturing back. So how do you incentivize that? Allow someone who does that to build a plant and write it all off year one. That's like, that's huge.
And I think we can see the opposite effect of, part of why commercial real estate did take such a hit and hasn't rebounded as quickly is because that tax incentive virtually disappeared. 40% was basically
from
nothing.
100.
And if you go back and you look at history, it's really interesting how these parts align with the 70s into the 80s. As interest rates went up, commercial real estate was crashing as well. Basically, anything that was valued based on treasuries. But what happened was also tax benefits went away. And so you started to see less incentive to do deals to make 5% cash on cash return if you don't have those tax incentives. So I think it'll be a huge boost. Let me ask you this, because even though it passed a couple of weeks ago, I've been traveling and dealing with family stuff, and I haven't dug beneath the hood.
Sure.
Do you know if all of the things you could bonus depreciate are reinstated at that 100%?
I believe so. Cars, autos,
like cars. Yeah.
No, I believe it's all there. Section whatever it is, 181 or 187, whatever it is. It's all the cars again.
That's going to keep people also buying cars. Even
you and me both. Yeah. I'm seriously thinking
after our show last week, I'm like, I need another vehicle. I have another driver turning 16 and my vehicle, my husband's vehicles, they're driving, but we have company cars. And I'm like, instead of buying my 16-year-old a used car that he can wreck and keep him alive in his first couple accidents, because that's what usually happens with 16-year-old boys, I'll just pass the next car to the daughter, pass her minivan to him that's been dinged up and wrecked by all of them. And then I'll go buy a new car, even if it's a little more expensive, so that I can get the bonus depreciation and write it off for my company. And so
exactly what I'm thinking.
Incentive is put in there so that even though the administration knows we're putting in tariffs, if we can get people to still spend to offset that, it won't be as bad as everybody thinks it's going to be. That's their hope.
Yeah, I mean, I'm serious, right? So I'm looking at the SUVs, right? A G-Wagon, or one of these very expensive cars that are over 6,000 pounds to qualify for the write-off.
Yeah.
And again, I don't buy new, I buy used. So let's just say it costs 150 grand, and I use it for more than 50% for the business, and whatever rules there are, I can write that purchase off on my taxes, right?
Absolutely.
So I think a lot of
I do. Yeah, Michael, it's just, I don't buy used anymore. Just my own personal preference, although I used to. I will look for a program car, and I did that for my son that has, 10,000 miles. Maybe it was a dealer drove it, or it was a lease for a year or whatnot. But if you go December 25th, December 26th,
the last week,
they have to move off all their last year's inventory because they're making room for the 2026s.
True.
And they will drastically slash their prices. And then you go in and you only have to drive it one day. It has to be in service one day for your company in order to take that tax deduction. So what we've done twice in a row with a Dodge Power Wagon and a Chevy Traverse, we didn't go crazy, but $50,000, $60,000 vehicles, is we got about 10,000 off of sticker by doing it the last week. And then we put in the 0% financing just to get it and hold our cash. Sure. And then we drove it a day or two, wrote off 100%, and then we just paid it off, the next year. Didn't mind the car payment.
I may do that. I may go new this time. I would typically get 2-year-old cars, so I don't get hit with that monster depreciation. But I'll look at that. I'm not in a rush to buy, but I have to buy. The fact is, I need to buy a new car. My dream car now has 115,000 miles on it. It's starting to have little problems. It's 15 years old. I'm like, I'll keep it. I won't trade it in, but I need another car I can drive.
Michael. You can tell you've got a grown daughter. I've got 4 kids, and we put on like 20,000 miles minimum, like every 9 or 10
no, we're not driving much anymore.
I want you to get that nicer, more expensive car. We're like, hey, we're still pretty economical. 50, 60 grand a car when you got 6 people that need cars eventually. It's like, okay, when they're all
I don't have that problem.
College, then I'm going to go buy that really sweet Corvette. But I'm waiting until their colleges are done, and I'm like, I'm done. Now I get to go play with luxury vehicles that I can.
There you go. It's really interesting because I know there's a lot of concern, and I think you have this, is like the recession is near, and we could trip over a rock and we're in a recession. Mm-hmm. I'm actually looking at the dominoes, and again, I've called a recession twice and been wrong. So I want people to realize I'm not some guy that's always positive. I've been there with the recession call twice and wrong. Mm-hmm. I'm looking at what we're doing. The fact that we're almost to July 20th, which is the 6-month mark from the inauguration. There's going to be an increasing focus on winning the midterms shortly thereafter. And I think all of this uncertainty just moves in the, I really think there's a chance that the economy is stronger in the second half than the first half. No recession. And then another thing that I think most people are missing is like no tax on tips. No tax on, or, I don't know, a $6,000 credit for Social Security, however that was handled. A lot of people at the bottom who have the highest propensity to spend will be spending more. Yeah. It's just a fact.
True.
So, again, as you've talked about, I think you said on this show, 70% of the people live in a check to check. Well, guess what? The net check's going to get bigger. Yeah. And guess what they'll still do? They'll still spend everything. Yeah. So, I'm feeling modestly optimistic that the second half will be stronger than the first. Call me crazy. What do you think?
No, I don't think you're crazy at all. And I don't think you were wrong on recession, Colin. I don't think I was either. When you go back and look at it, now they haven't been declared, but you go back and I watch very carefully the conference board's leading economic indicators. And we have been in The red line, recession, twice,
Twice, yes.
2022 and 2024, where if you look at their notes, they're like, we are in really contractionary, even recessionary conditions. However, there's hope in these 3 out of the 10 leading economic areas.
There was always jobs. Jobs was always.
There was always something there, right?
Yeah.
And regardless of how manipulated you think the numbers are, some of it's just incompetence and not updating the way that numbers are calculated.
Yeah.
And some of it is definitely politically driven, delaying calls that should have been there. But we were in recession conditions in 2022 and 2024. Not called, and this is where to your earlier call that this may be looked back and called rolling recessions.
Right.
It's not that the recession call was wrong. It's that, yes, the majority of the population was in recession, but the breadth at the high level wasn't low enough to get it called technically.
That's what I think. That's why I think it'll be called a rolling. You got to call it something. You just
you can't go back and say this was a great economic time period. No, it was clearly a rolling recession. And again, you look at, we've talked about the hope framework. We've had the housing crash and housing recession in terms of transactions. We've had the orders in manufacturing in a recession. We've had many corporate profit misses other than, especially in discretionary sectors, propped up at the stock level by the Amazons and the Mag 7s, but others already in those recession. And we've had employment in several areas already recessionary by historic, in terms of the month over month change, the SOM rule and things like that. So we've rolled through the whole part of hope. It's just not at the breadth. And so,
it wasn't, and it also wasn't at the same time. That's why this rolling recession is starting to feel like a decent call.
Yeah. I think this is kind of the first time, and I don't know, I'd have to go back and check in.
They called 91, at least when I was studying, they always referred to 91 as an example of a rolling recession. It was rather short.
Very short.
But this is going to be the one
by high inflation. And that's the part where, I think part of the 70s into the 80s, and we did have an administration change and we had big tax reform and things like that as well. And Reagan actually got, the recession and then things started to get better. And so, I think this is still pretty similar to the 70s into the 80s where you have high inflation at the same time as kind of these rolling recession. So I think it'll be kind of a rolling recession slash stagflation like period of time. And the good news for the optimism. And I agree with you, Michael. We've always got to realize, even though it might seem kind of doomy, and for a lot of people, this is a doomy period of time over a few years where they have struggled. And we are very blessed to be in the position that we worked very hard to be in, but where we are in that upper income range where it hasn't hurt us as badly. And that's one of the beauties of what you and I teach on this channel. It's all about taking your own personal economy into your own hands.
Yes, please.
Regardless of what's happening in the world, you have choices to make that can let you weather these types of things into the future so that when you hit the bottom, you're okay. And then you take advantage of that bottom to make really good choices on the ride up. And what we have seen, at least in the past, and I expect it to continue, I might not know how it's going to continue. I may not like the president. For those that have called me MAGA, you're wrong. I really don't like him very much. Okay, I'll tell a secret. But I have to bet and hope that he gets it right, and that for the sake of our country, this administration's things that we see right now and go, this is nuts and this is crazy and we don't like it, or why would he throw off the tariff risk at the same time that we're, about to go into a recession? Like, we can ask all the whys, but we better all hope for the best for this administration and for our country so that we all end up in a better place tomorrow. And history tells us, which makes me optimistic, that once you get past these periods of stagflation, you get past these periods of recessionary type conditions, you do hit a bottom, and it takes a while to recover. Once you hit that bottom, it's usually 2 to 3 years of a recovery. But once you get past that and you weather that, Michael, you always have an expansion. There's something that comes in to create that productivity boom. And I'm hopeful that even though there's things about this big, beautiful bill that I don't like personally, there's other parts that give us some hope that if the administration is successful getting people to spend at the bottom, making us not as likely to go into that deep recession, getting some trade agreements, getting productivity and investment back in the country to where in a few years from now, we do have that 3% GDP, then it's very hopeful that we can get inflation down because the tariffs are deflationary over time. We can get productivity up and we can be in a better place economically. And so I'm hopeful for that too. For those that have called me a doomer, I'm not. But I just know that right now we're not yet in that expansion that everybody's hoping for every time they see a headline that seems to be good. We might have another year or two of pain, of maybe not more painful than it is. But even if that recession's declared, Michael, just to go back as a reminder for those that haven't been listening to us for a long time, an average recession lasts about 10 months. And we've already rolled through 2 years worth of recession-like conditions. So it may be that we hit a bottom, it's declared, and then we're recovering really, really quickly. And then in a few years, we have this economic boom. And these tax cuts initially may be the thing that keeps those tariffs and keeps that inflation from really putting us into a deep depression that everybody's been worried about. I'm a little more optimistic today than I was, a few weeks ago as well.
Nice. Oh, I like to hear that. Yeah, I'm leaning that direction. Again, I'm certainly not over my skis yet, like calling it from the depths of my chest, but I'm like,
yeah, if you said by December, I'd say you hit your head.
No, I'm like, this might be a little bit better than people are thinking. Because again, the other thing about recessions, it's really a statistical anomaly and frankly, a comedy, is by the time they call it, it's usually over.
100%. Yes.
Crazy.
Like we've seen twice that we've been in the recession warning era and way below it, and it wasn't called.
Yeah.
And there's many reasons for that. But yeah, usually they're called. Do you know the Great Recession of 2008, 2009 was backdated 18 months, but it wasn't even called for almost 2 years.
Yeah,
so, they look backwards and then they tell you what you already know. So always be hopeful. I always like to end on a hopeful note, and I know you do as well. There are still good deals to be had. There's still ways to make money in real estate. There's still ways to make money, with side hustles and different things. But these are the kind of times where you either wallow in fear and you don't do anything, or you say, okay, how can I, regardless of what happens in the next several months, what can I do today to make my tomorrow a little bit better and to prepare me for the time when the economy is really booming again? And so that's what I try to focus on and try to get my students to focus on. And I know you do as well.
Anna, where can people find you?
You can find me here on your show. You can find me on social media at Anna Kelly, REI Mom. And if you're interested in real estate and wealth coaching and consulting, you can find me on my website and book an appointment at AnnaKellyInvesting.com.
Thank you so much. Have a great week.
You too.
Bye.